The Federal Reserve System, the Central Bank of the United States, recently announced a 0.25 percentage point increase in its base interest rate on July 27, marking the highest rate in 22 years since 2001. This decision has raised significant concerns in Korea due to the substantial interest rate gap of 2.00% between Korea and the United States. Today, we will delve into what the base interest rate entails and explore how the fluctuations in U.S. interest rates can impact Korea. The base interest rate means the interest rate used when the central bank trades money with general banks. For example, if the base interest rate is 1%, the general bank can borrow money from the Bank of Korea at 1% of the base interest rate. That means you have to pay 10,000 Korean won as interest if you borrow 1 million South Korean wons. Banka borrows money with this interest rate and makes a profit by lending money to people with a higher interest rate, for example 2%. If the Bank of Korea raises the base interest rate, Banka would raise the interest rate for people as well. So, the base interest rate set by the central bank is connected very closely to people's life. The central bank changes the base interest rate to control the flow of money in the economy. When the economy needs a boost, they lower the interest rate, making it easier and cheaper for people and businesses to borrow money. This encourages spending and investment in assets like real estate and stocks, and helps companies grow. On the other hand, if the economy is growing too fast and could lead to higher prices, the central bank raises the interest rate. This makes borrowing more expensive, which slows down spending and investment, preventing the economy from overheating. By adjusting the base interest rate, the central bank aims to keep the economy stable and growing at a healthy pace. The reason for raising the base interest rate is the concern about an overheated economy. The COVID-19 pandemic disrupted normal production and consumption patterns, leading to a significant influx of money into the real estate and stock markets. This surge in demand caused real estate prices to rise, which, in turn, contributed to an overall increase in prices. As a result, businesses like restaurants faced higher monthly rents, forcing them to raise their prices to cover the costs. In response to this situation, the United States Federal Reserve System announced an increase in the base interest rate, aiming to slow down the real estate market and curb inflation. Consequently, the real estate market experienced a slowdown over the past year as a result of this measure. Then, why does the fluctuation of the base interest rate in the United States affect Korea's economy? The most obvious reason is the foreign investors. The interest rate is not only an expense for borrowing money but compensation for lending money. As a result, if the base interest rate of the United States is higher, foreign investors would prefer to save their money in the United States banks. It is very important to prevent the leakage of foreign investment funds since they affect positively national growth. As you can see, the base interest rate of the United States is related very closely to our life. We need comprehensive countermeasures for the high interest age.